Hello, my fellow investors, and welcome back to another fundamental analysis video. Today, guys, we're going to cover the company CVS. Now, during the live stream that we did, which by the way was awesome, especially on the Rumble side, Ghost recommended the company for CVS, seeing that they do have earnings tomorrow. As if you guys are seeing this, it would have already happened. So let's cover the company, guys, CVS, and see if maybe this is a company that we may want to buy. Seeing that, well, the earnings estimates aren't looking too good when it comes to like the revisions. They're downhill, and also the stock has fallen a lot, at least as if I'm recording this. So before we get started, make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on X at Fatal Investing. If you'd like to join us on the Discord, link is in that description below. So with that said, let's get started with this analysis. So let's start off with their earnings summary, or at least what they're expecting. When it comes to the past earnings, we can see that this was done on May 1st, and we can see that the EPS normalized actual came in at $1.31, misses by 39 cents. EPS gap actual, 88 cents, misses by 44 cents. And the revenue, 88.44 billion, misses by $766.97 million. Now the next earnings, you can see over there on 8/7. Again, you guys would have already seen it. We can see that EPS normalized estimate $1.73, EPS gap of $1.36, and the revenue estimate of $91.43 billion. 8 revisions, all of them to the downside. So we'll see how in the world this company reacts when earnings actually release. Now, if we take a look at the current state of the stock, we can see that on the intraday, as I'm recording this, it is Tuesday, August 6th, at around 10:30 p.m. But we can see that intraday it gained 0.92%. Post-market, though, down 3%. So this is very, very interesting to say the least. Now, if we take a look at this chart, we can see that on the 1 year, they are down 21.07%. And on the year to date, they are down 26.11%. Now, the one thing I do have to mention, guys, is that CVS is essentially, I would say, like a duopoly with that of Walgreens. And if we take a look at what happened recently with Walgreens, they are down a whole lot, 63.5%. You guys can see there on the 1 year, and on the year to date, they're down 58.22. Now, this was due to more than just market share when it comes to like Amazon and the like. I think Walgreens had a lot more issues right down the line that started to pop up as opposed to CVS. So I'm only showing you guys just to show, hey, careful, because other companies in the same kind of industry are a little bit teeter-tottering here, right? However, CVS, by the looks of it, it doesn't seem to be as bad as Walgreens was. So with that, let's actually head now into the calculator. We got the ticker for CVS, a market cap of $74.11 billion, a PE of 10.25. I actually like this PE, guys, a lot. It tells me that, well, it tells me that the company doesn't seem to be too much overpriced. Current share price of $58.34. We already took a look at the graphs. However, let's take a look at that 52-week range one more time. And if we take a look at this, we can see that the 52-week low is $52.77 and a high of $83.25. So you guys remember, we're at $56.65, so we're very much near that 52-week low. So now, if we come back over here to the calculator, we can see that they do pay out a dividend of $2.66, which is a yield, guys, it's a whopping yield, 4.6%. Now, I look at this yield and I'm like, red flag, kind of. We're going to take a look at this kind of free cash flow and see if they can actually afford this dividend with their cash flow, right? Because again, free cash flow is how companies pay out their dividend. And, well, 4.6%, it looks good, but be very, very careful. Now, this ends up being a payout ratio, which this is not in regards to the free cash flow, of 31.59%, a 5-year CAGR of 5.39, 2 consecutive years of dividend payment. If I'm not mistaken, they did cut it, I believe, during COVID, if I had to guess. Or maybe they just, okay, no, they did not cut it. They just didn't increase it. I don't see this as a bad thing, right? I do not see this as a bad thing. Even if they cut it, I really don't see it as a bad thing. But the fact that they just maintained it all throughout 2020, 2021, 2022, actually, and then increased it in 2022, tells me that they're at least able to be like, all right, we want to be able to afford to live, to survive. We're going to forego the dividend, aristocrat king title, right? As long as we keep giving out that dividend, people aren't going to get too mad. People are going to get even more mad if we do cut it. So I'm perfectly fine with that. Ex-dividend date passed as of July 22nd. Payout date was on August 1st, and they pay their dividends quarterly. Come back over here, we can see that they're based off of the current shares outstanding and this $2.66, they pay out $3.3 billion in dividends every single year. Take their 10-year average free cash flow, subtract this number, we get $6.3 billion. Take their last year's free cash flow and $7.1 billion. So it is increasing, not by a lot, but it's still increasing. We'll take a look at the graphs and see if this is a trend. And lastly, when it comes to the payout ratios, we can see that these payout ratios, guys, are actually really, really good, right? This payout ratio is really good. 32.04%, 34.54% for the payout ratios in regards to the free cash flow, meaning that they can afford this dividend and they can even afford to increase it if they so wish to do so. All right, so now let's jump into the fundamentals. Starting, of course, with the net income. We got 10 years ago, guys, of $4.6 billion to 1 year ago of $8.3 billion. Now, the main outlier here would be 6 years ago. I believe this was 2018, if I'm not mistaken, as well as 2 years ago. Now, the 2 years ago one, I guess you could say interest rates, right? But the 6 years ago, I'm not really too sure. This is still an increase though of 80%. Honestly, it does look very consistent. It really, really does. So all in all, I'm going to have to say, guys, a solid, it looks good, right? It looks good. I'm going to say like an 85%, mainly because I just do not know as to what caused this drop in their net income 6 years ago. Now, the free cash flow is the one that matters the most to me. We got 10 years ago of $6 billion to 1 year ago of $10.4 billion, increase of 73% with an average of $9.64 billion. Here, the drop happened 7 years ago, but then it continued to go up. 2 and 1 year ago is where it's starting to decline a little bit. I'm going to have to say, guys, a solid 70. I'm going to say 70. I'm not. Oh boy, this is actually a little bit difficult. I'm going to say 70% and be a little bit more conservative when it comes to that number. Now, looking at the revenue, this revenue looks insane. 139.4 billion to 1 year ago of 356.6 billion, increase of 155.89%. This looks nearly perfect. It really, really does. The spike here happened from 6 to 5 years ago, but aside from that, it's still very, very consistent. So I do like this graph. I'm gonna have to say, guys, 100%, honestly, because even that jump from 6 to 5 wasn't really a lot by retrospect. So yeah, that's kind of what I'm going to put when it comes to the revenue. Okay, looking now at the total assets, you can see that this is increasing, and the liabilities are doing the same thing. You can see that 6 years ago for both is when this thing spiked. And if we take a look at the assets minus the liabilities, you can see that the spike once again happened 6 years ago, but it is still somewhat increasing. 2 years ago, it dipped a little bit, but again, interest rates, that's just what I would think. Average total assets of 178.8 billion, liabilities of 120.6 billion dollars, and the assets minus the liabilities, we got, what is that, $58.2 billion. I'm going to have to give this, guys, I'm going to say like an 85%. It's really, really good. Cash flow minus the liabilities. Yeah, I mean, their cash flow is doing okay, but you can see that they're packing on liabilities, especially beginning 6 years ago. That is definitely driving everything down. As of last year, or as of 1 year ago, they are at $163 billion, negative $163 billion. The average being negative $105.45 billion. I'm gonna have to say I don't like the fact that it's continuously decreasing, but it does have instances of it increasing. I'm gonna say, guys, I was gonna say 65%. I'm gonna say 65%. Now, the shares outstanding. This is interesting because, okay, now that I've looked at pretty much all the fundamentals here, I'm fairly certain that this 6 year ago, something happened, right? They probably issued, they probably did an acquisition or did something along those lines, because the shares just spiked. So they've definitely used their shares outstanding. They definitely did something there. So again, figure it out for yourselves if you're interested to buy this company. 10 years ago of 1.14 billion shares to today of 1.25 billion shares. That is a decrease, guys, or at least an increase of shares, sorry. That is an increase of shares of 9.82%. They are diluting you on the 10-year. However, previous year to the current year, down 2.8%. So they're basically buying back at 2.8% previous year to the current year. Something to note. from 6 to 3 years ago, increasing shares. Then from 3 to today, buying back shares. And then from 10 to 7 years ago, buying back shares. What this tells me is that they understand that they issue shares when they have to issue, and they buy back shares when they have to issue, or they buy back shares when they want to buy back shares. So I look at this and I'm just like, I like how they manage their shares. I really, really do. I'm going to have to give this, guys, not 100%, because I would like 100% to be like buybacks, but I'm going to say like a 90%. I do like it a lot. Now, lastly, cash and equivalents. They currently hold $9.8 billion with an average of $6.2 billion. Overall grade, 83%, guys. Yeah, the company looks good. The fundamentals, honestly, look really, really solid. Now, the price. What price do we pay for this? PE looks good. Everything else is looking okay. What price do we actually pay for this? Let's find out using the discounted free cash flow. All right, so now let's take a look at the discounted free cash flow. I do have a little one right here to see if she's going to try and help me here. So guys, let's take a look at this. Now, we can see that not inputting anything, we got $353.55, and then adjusting for debt, $306.50. So let's take a look at this. When it comes to the shares outstanding and issuing and buying back, they've been issuing on average around 1.75%. So let's say -3 that they issue. Then let's go to -2. That's right, Daisy. -2. I like how she's probably like, what in the world are you doing right now? So -3, -2, and -1, they're going to issue, right? Best case scenario is that they will only issue 1% of shares. Now, when it comes to the revenue, they've been doing 11.44%. So let's say at around, guys, let's say around 7, then let's say 9, and then let's say 11% when it comes to the revenue. So you guys are looking at these numbers and you're like, that's crazy. 1,100. Well, now the required rate of return, let's change this to around 12%. It's CVS. I don't expect them to grow that much. Let's say at around 12%. Beating the S&P 500 essentially, and we got $125.22 to $204.37, and then adjusting for debt, $90.22 to $161.78, margin of safety at 5.10.15, $76.68 to $153.69. She likes the mouse, by the way. So I look at this and I'm like, honestly, with a PE like that, I kind of do understand it, right? I kind of do understand as to why I'm getting these prices. And honestly, I like the fundamentals do look good overall, right? 80%, really, really solid. And the discounted free cash flow does look pretty good as well. So yeah, by these numbers, CVS does look like a great buy. Not to mention that dividend. And if we remember this right here, well, you guys could see that, yeah, they can easily afford this dividend based off of the payout ratio in regards to the free cash flow. And of course, looking at this dividend a little bit further, guys, that is a 4.6%. This dividend is a whopping $283.37 annually if you put in $6,215. So yeah, honestly, the company does look good. The one issue that I have when it comes to this is be wary when it comes to the whole thing of like, well, CVS going the likes of Walgreens, right? But it doesn't seem to be that way. So again, please do your own due diligence. Figure out what happened 6 years ago as to why that fell. But it doesn't look too bad, in my personal opinion. Not financial advice. Obviously, every investment is the present value of all future cash flow. So all in all, when it comes to CVS, I like it, right? I like it. But again, guys, not financial advice. Every investment is the present value of all future cash flow. So with that said, guys, tell me what you guys think. Do you own this company? Do you want to own this company? Has this made you, want to research them more? Are you excited for their earnings, right? Are you excited for their earnings? Let me know in the comment section below. Obviously, you guys would have already seen that. And yeah, guys, with that said, make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on X at Fatal Investing. And if you'd like to join us on the Discord, the link is in the description below. So with that said, guys, peace out, and we will see you all next time.